Hello, guys. Thank you for tuning in. Interesting episode for you today. It's about time we spoke about some markets. Last time, I think we're meandering a little bit. So let's talk market performance. Phil, over to you.
Yeah, mate. Look, it's been I don't know, an interesting week and a half or something. Last few days, anyway. Things are a bit up and down, I suppose. Is probably a good way to put it. And I really just wanted to get something out so we could sort of give a bit of context around what's going on and our thoughts on portfolio management through times when there is a bit of market volatility and maybe a bit of uncertainty, or at least doom and gloom on the news. They certainly like to make it sound scarier than what things actually are. Yeah, so that's sort of what we'll be talking about today. And actually, I just was having this conversation with my wife last night because the news came on and got to the finance section. I can't remember the exact numbers. 44 billion wiped off, or a quarter of a trillion wiped off the Australian stock market. It was like 1 point something percent. I'm like, yeah, you make it sound real scary. So it's, I don't know. It's kind of funny, all the hype.
Yeah, so I think like the consistent portfolio management position that we take is that every 8 years there's a black swan event that has significant 30-40% downturn. It's been 5 years since we've had a significant black swan event, which means you have no idea where it comes from. It's a macroeconomic event. In the taillights, it's obvious that was going to occur, but we know there's going to be something coming in the next 4 years that's massive. We build the portfolios in a way in which they can capture both the up and down side. So that's something that's obviously very, very important to us. But the purpose of today's discussion, which was just go through market volatility, interest rates, some uncertainty. And I can see, Phil, you've made some notes on it. So let's get into your notes.
Yeah, well, I suppose it's worthwhile. Like I said, a lot of doom and gloom on the news and a lot of talk going on. And yes, markets have been a bit choppy and a little bit up and down. Obviously, the big one, or the elephant in the room, is Trump's trade wars, or all the back and forth and flipping and flopping on these tariffs and who's getting a tariff and who's not getting a tariff, and changing day by day and upsetting everybody. And look, I think I wouldn't really say we're having a significant market fall or decline or anything. It's just up and down a bit, and probably a little more down than up. But a lot of that uncertainty is just probably due to uncertainty of outcomes at the moment, and who's going to react in what way to whatever's getting proposed, and what's actually going to stick and what's not. And so I think, my take on that is probably it's going to probably drag on for a bit longer. We're probably going to see this choppy environment for a bit longer. Scott, you're the economics man.
I think a few points. First of all, it's not even a buying signal yet. I reckon we need markets to come off more before we start pushing a bit more aggressive. We're still up on the year. We're still the stock market has basically just gone. It's just had an inflationary up and inflationary down since the Trump election. So we're in the same position from a market perspective when the US election went through in November. So all we've done is just gone up and down a little bit. And at that point in time, markets probably in our view was still really very frothy. And by frothy, I mean we had 70 huge companies in the US that had dragged everything forwards. And especially with that NVIDIA parabolic upswing in sort of mid to late 24, that also dragged things upwards. And we're still at that position now. So I think it's about having a diversified portfolio. We've only got, what is it, like around 30% of our portfolios our base portfolios are about 30% in the US and then 70% everywhere else. Yeah. The only thing that I think was quite interesting was I saw one investment. I think something, it was put out on X, and they were talking about people who were trying to not buy American products. It's really difficult. Pretty much everything you touch and use is actually an American business, which is kind of weird. So if you think about it, all the tech software we use Microsoft, we use Google, we use Amazon, we use Apple. Those are sort of like the most common sort of tech products that we use on a daily basis. And then all the social media platforms are all US owned. So that it's kind of this like total US specific monopoly, which is quite interesting. So I think based on that, you want to maintain your exposure to the US market, just because it's really got that monopoly stitched up, and there's a huge structural moat that they've created. The only thing that I'll touch on, which is Donald Trump's managed to take a casino and it bankrupt twice. Donald Trump is a terrible businessman. Yep. His entire history is based on bluff and bluster, and by going after your friends, e.g. Canada and Australia, it's one of the best ways to create isolationism, which is then going to be producing an upswing in European portfolios. Europe really needs a bit of an innovation, and we're seeing that coming out. and we've got about a 20% allocation to the EU. So great, let's get that running because we have that diversification across the portfolio.
I actually saw something wild the other night, and it was an analysis of a whole bunch of EU-based businesses that are in some way related to weapons manufacturing or stuff that war would benefit from. And all those, ever since all this trade war tariffs talk started happening, have all gone through the roof, which a little bit concerning.
Well, I think what's more concerning is that there's like the joke about the Volkswagen factory is going to start making tanks.
Yeah, that was a bit of a wild one. And I mean we touched on the AI and the tech stock stuff a bit in the last episode, but it was interesting reading while I was sort of pulling some notes together that it was at Tesla, Nvidia, Alphabet, Meta, Amazon, Apple, and Microsoft have collectively lost 1.5 trillion since the beginning of 2025.
How many?
How
many billions is a trillion? What is that?
God, I don't know. It's just got a few extra zeros. Yeah,
the human mind. If you're listening to this right now, go and Google the difference between 1 million and 1 billion. And are you aware of the difference in it? People are really bad when it comes to understanding dollars, but we're quite good in terms of time. Have a guess what the difference is between those two. So take a guess. How many seconds are in there for a million seconds? There's about 11 and a half days is 1 million seconds.
I would have thought that would be longer.
Yeah.
There you go.
Do you know how many a billion seconds is? 31.7 years.
Yeah. Okay.
Big difference.
Big difference.
So a trillion and a billion are very different. So basically, So the summary from this one is market volatilities are coming up. It's maintaining domestic exposure, maintaining EU exposure, maintaining US exposure. But all I would say is that we're in for a silly 3.5 years. The only other final point that I'll just touch on from a geopolitical perspective is it's something that's very close to my heart, which is submarine. And why is that? Because I like what's called asymmetric warfare, which is you can have an entire squadron, but if you have one submarine, it can take an entire city out. So that's why you only need three submarines, and you've got basically a complete level of defense. So what happens to pop up in the Canadian port just off the US? A French nuclear submarine right now sitting in Canada. What a silly thing for the Trump party to do to start talking about taking over Canada.
Oh, it's just wild. It's just absolutely mind-boggling. Yeah, which I guess, and look, the Australian tariffs actually caught me a bit by surprise. I've been saying for months, they're not going to slap any tariffs on Australia. We're so insignificant in the terms of trade. Who cares?
He's just been blanket. He's blanketing everyone. So every single place that has that. But something that I'll note, which is kind of interesting, is especially this Whyalla steel mill that they're putting $2 billion into. That's kind of an interesting one. If you look at actually where that steel goes to the US. What does the Americans actually do with that steel? Why are they buying steel from Australia specifically? And the answer is because the Australians have done a deal in which we buy warships from the Americans on the proviso that the Americans buy Australian steel. So what's happening is we're manufacturing our own steel. We're sending to the US for them to process it. We have a contract that we have to buy this steel back. So that tariff's going to get hit. And now we're putting that exact steel in our warships that we are then having the US build. That's the only reason this is occurring. There'd be no other reason for them to be buying Australian steel because it is uncompetitive. So how's that for a circle of life or a circle of government inefficiency?
Yeah, that's probably the more accurate statement. So I guess really the point and why I want to do this particular episode really is just to kind of calm any nerves that might be out there, because every time I turn the news on, they're blowing stuff way up. It all sounds doom and gloom. The ASX was down like 1.3% yesterday. Sounds far less scary than $250 billion wiped off in one day. Whatever. The point and the point of that is, for any of our clients, your money's well diversified. It's well spread around. Your portfolios are built with the expectation that some years we're going to lose money. It happens. Nothing any of us can do about it. We can't control the entire universe. We can control the sensible decisions we make. If you want to see the consequences of what happens if you attempt to time markets and you bail out when things are down and bail back in when things are good, find our episode a while ago where I did the math about an argument I got into with a bloke at barbecue and how he did a number on himself during COVID. But the point of this is stay the course. We're looking after it. We've got things under control. Things are going to be choppy for a little while.
Maintain the discipline, adhere to the strategy. Like I said, to be specific, when just going a little bit more granular, we've got the diversification. Not only this, but the portfolios that we're running have an internal mechanism which is generating cash, is generating free cash flow. And what that means is that usually your super's going in, plus your portfolio is also generating income, and then it's buying itself. So as the market goes up and down, you've got this consistent income generation that keeps going in, which is going up and down, up and down. So if we do have, and if a 30% drop down in markets comes through, you'll be buying that portfolio at a 30% discount to today. It's the only person that should be really worried about that type of drawdown is what's we refer to as sequencing risk, which is if you are looking to retire next week. At that point in time, you're going to have a very different portfolio.
And if you're one of my clients that's retiring next week, we should have known this was coming and we would have planned for it. And if you haven't told me, well, silly you. Just to hammer the point home a little bit more. Hopefully we can see that okay.
For those listening, we use an internal comparison tool that's looking at data from 2018 till current. Phil has got the growth of $10,000 on his left-hand side, and he's also got a drawdown analysis on the right-hand side. Phil, over to you.
Exactly right. Yeah. So what we're looking at here is a representative growth portfolio and a growth index. I won't bore you with all the technicalities here because the key point is this is a drawdown analysis, right? I find this chart really interesting. It's my favorite thing to bore people with. This line across here is 0. And this is any time that the benchmark or any of these growth portfolios have fallen below 0 or had a below 0 return from 2018 through to now. And you can see there's a bit there. And that's what we're talking about with volatility, right? Markets are going to go up and down. We know there's going to be downturns. And this big spike, and the reason I pulled this particular chart is this was COVID. And we've all lived through COVID. Most of us were investing through COVID, had super through COVID. Most funds fell by, in the range of 15 to 30%, depending on how aggressive they were. And this is Scott's point, throughout this entire period while markets are down, every time your employer's putting contributions in or whatever else is going on, we're just buying stuff at a discount. And actually, this kind of sounds a bit flippant, but, I'm not really that worried about how far it fell or the fact that it did fall. What I'm worried about is, did you get your money back and how quickly? 13 months in the example of COVID. But you need to look at this chart at the same time as this. This is the growth of the money invested over the same time period. So even though we've had all these dips along the way, this volatility, these ups and downs, this kind of craziness that goes on out there in the world, long term, the money's growing. Those ups and downs are just part of investing. There's your COVID dip there. 13 months, you had your money back and you're back on the upward grind. So, all that to say, and the caveat to that is that you've invested in sensible assets, you're well diversified, and you've not done anything stupid, which obviously you're one of our clients. That's exactly the position you're in. Just stay the course. It's all good. We'll let you know if you need to do anything. But other than that, stay the course, work the plan. If you feel nervous, you need to ring us.
Thanks, guys. I just wanted to touch on talking about that. As we were talking, Phil, one of your clients, Janet, just left us a 5-star Google review. And I'm just going to read it out very quickly because I think it kind of makes sense in terms of what we were discussing today. Janet says, I'm coming to the end of my career and sought out financial advice. I was quite nervous and had never engaged in this field before. Well, can I say I wish I'd made the move earlier. I'm feeling confident with Phil's advice and action for me, looking ahead with joy. Oh, well done, Phil.
Amazing. Actually, hadn't seen that review. So, thanks, Janet. That's awesome. It's really nice. Thank you. Made my day.
All right, guys. Thank you so much for listening. If you've got any questions about this or other topics, please let us know. If not, next podcast we're going to be doing on is a example of one of the, I won't say one of the worst, but one of the silliest investment things that I've seen come across our desk. Some of the due diligence we would usually do and how you can do it yourself if you ever have an investment scheme that you have thrown on top of you by a friend and you go, I reckon this is bullshit. We're going to give you some tips on how to do that. Watch this space. That's the next episode to come. Thanks, guys. Have a great week.
Sounds like a fun one. Thanks, guys. Cheers.